Imagine walking down the aisles of your local grocery store, spotting a new brand of frozen dinners flying off the shelves. Most investors would shrug this off. But Peter Lynch, he's already jotting down the company's name, sensing a hidden gem nobody else has caught yet. What if your everyday experiences are secret maps to massive profits? That's the open loop Lynch cracks wide open. How your simple daily life can beat Wall Street's smartest pros. Why does Lynch believe you have an edge over professional investors? Because you see the world with fresh eyes. Every day you're around products and businesses before the experts even hear about them. Lynch tells the story of his wife shopping in a New York supermarket who noticed new, in-demand products moving fast. Instead of ignoring it, he bought the company's stock early. This was Crucial Foods, a small frozen dinner maker that later soared tenfold, a classic ten-bagger discovered by paying attention where professionals ignore. Think of investing like being a detective. Everyone else reads reports. Investors like you, armed with daily observations, gather clues no one else notes. A new restaurant line buzzing, a sudden local craze, or an uptick in employee perks. These small signals can tip you off to a stock's future before it hits the analyst radar. When Lynch started applying his own insights, his portfolio transformed. The magic, a few ten-baggers, stocks returning 10 times the original price, can turn a so-so stockpile into a stellar fortune. You don't need perfect picks, just patience and a sharp eye tuned to reality, not Wall Street's forecasts. Most investors glaze over financial reports. Lynch gets energized by them, because inside those numbers lie the difference between a no-shot and a jackpot. Lynch recounts his deep dive into Dunkin' Donuts financials. By studying their steady earnings and cash flow, he realized the company's real strength wasn't obvious to others. This gave him confidence to invest early, earning huge returns as the company expanded nationwide. The price-to-earnings ratio, the PE, is Lynch's favorite compass. He compares it to shopping for a house. You want the price relative to what the property or earnings produces. Too high, you're overpaying. Too low, could be a bargain or a trap. It's about context, not just numbers. Not all earnings are created equal. Lynch warns about companies that cook the books or rely on one-time windfalls. Instead, look for consistent organic growth, like a tree growing steadily year after year. This helps dodge glittering traps that look good but bite hard later. Not all stocks are created equal. Lynch gives you a roadmap to spot fast growers, cyclical stocks, and companies on the mend. Each type needs its own playbook. Lynch's favorite fast grower example was a small camera company launching innovative products in the 80s. The stock exploded as it captured market share rapidly. But he cautions you have to know when to get out before growth slows and valuations bloat into bubble territory. Cyclical stocks, like car makers or steel companies, depend heavily on the economic season. Lynch compares them to roller coasters, thrilling if you get on at the bottom, terrifying if you jump on at the peak. Mastering timing here requires study of economic cycles and patience. Turnaround stories captivate Lynch, the once struggling company that reinvents itself. He cites Chrysler in the 80s, pumping new models and management. Early investors who recognized the shift and held on were rewarded richly. The trick, distinguishing real change from false hopes, takes scrupulous research. Remember that grocery store aisle from the start. Next time you're shopping, ask yourself, what stories are the products telling? Peter Lynch's core lesson is simple but powerful. Your ordinary life gives you extraordinary advantages if you tune in. Try this. Pick one small company you genuinely use or love and dig into its story and financials this week. You might just find your first 10-bagger. Subscribe for more book summaries like this one.